Good afternoon. I'm Campbell McCrary. I'm Vice President Capital Markets at Amvest Capital in New York. Welcome you to the Amvest Capital Inc. live webinar with Skeena Resources. That's SKE on the TSX Venture and SKREF on the OTCQX. Welcome to the New York-based specialist investment management and corporate finance firm focused solely on natural resource sector. This call is hosted and recorded by Amvest Capital Inc. All opinions expressed do not reflect the opinions of Amvest Capital or any of its affiliates. This call is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for investment decisions. Amvest Capital Inc., its affiliates and clients may maintain positions in the digital assets or securities discussed on this call. Presenting today, we have Walter Coles Jr., President and CEO. Walter has served as CEO and President for several Toronto venture stock exchange listed mining exploration and development companies throughout the past 7 years. Before that, he was more than 14 years in investment management and investment banking. Walter entered the mining business as part of an effort to develop a mineral resource discovered on family farmland in Virginia. We also have with us Kelly Earle, Vice President Communications. Kelly is a geologist by background, spent several years in the field. He's a founding member of the BC Regional Mining Alliance and the founding Industry Advisory Board Chair of the Center for Advanced Subsurface Earth Resource Models. Following the presentation, members of the Amvest Capital team will ask questions of management. We also look forward to any attendee questions sent in. Thank you very much. Welcome, guys.
Thank you.
Campbell, thanks for having us. Delighted to be here with you.
Yes, sir.
So we'll launch into our presentation and give you, we'll start with a little history of Skeena and how we got to where we are today. Of course, we have the forward-looking statements that are always there in these types of presentations. But flipping ahead past that, give you, as I said, a little history on Skeena. I partnered with a bit of a legendary geologist, Ron Netolitzky, back in 2014 to take control of Skeena and realign its focus towards the Golden Triangle of northwestern British Columbia. That's an area where Ron Netolitzky had tremendous success in the previous several decades. And we had the thought to take advantage of the downturn in the mining sector over the last 5 or 6 years to be acquisitive, go out and try to acquire assets from major mining companies that probably wouldn't be available except for during these periods of difficulty in the mining space. So Skeena acquired over the last 5 years 3 projects. The first was the GJ project, which we acquired from Teck and NGX, and that's a copper gold porphyry. It's in the northern part of the Golden Triangle. And then we picked up SNIP in 2016 and Eskay in 2017. We optioned both of those properties from Barrick. The reason we focused in this area is because it's an area that's famous for incredible mineral deposits. It also has very supportive First Nations and provincial government support for projects in this area. So there are plenty of other famous mines you've probably heard of there, such as the Red Chris mine, which is now held by Newcrest, and Pretium's Brucejack mine. Launching into a little bit about our team, we're young, we're lean, and we're mean, I guess I would say. Our CFO is Andrew McRitchie. He came to us from Price Waterhouse, a very competent accountant. Paul Geddes came to us from Barkerville, where he was VP of Exploration. So he's our Vice President of Exploration now. Excellent at resource delineation. Kelly Earle is our VP of Communications, as Campbell introduced her. But I'd highlight that Kelly is also a geologist. So she brings a technical background with her business acumen. The last person on this slide, management-wise, is Justin Himmelwright. And Justin has a role that's not, you don't usually see junior companies with a guy like Justin. He is he's our VP of Sustainability, so he manages all of our permitting, environmental compliance, as well as First Nation outreach. In fact, Justin is also an adjunct professor at University of British Columbia on Aboriginal relations. So he's an incredibly powerful addition to our team. On the board side, Craig Perry is our chairman. Craig's one of the co-founders of NextGen, very successful uranium company. He's also partnered at EMR Capital. Borden Putnam, second person listed there, is our another board member who is a geologist. Borden originally worked for Newmont, and then over the last couple decades, Borden has been an analyst for several multi-billion-dollar investment funds in the United States, focusing on mining. Isaac Burstein is the representative of Hochschild on our board. We have a option deal with Hochschild on our SNIP asset. And then lastly but not least is Suki Gill, who's the chair of our audit committee. Suki has been an accountant here in Vancouver for the last 20 years, very accomplished as well. So that's our team. Now moving back into why we're in the Golden Triangle, I alluded to this briefly, that there have been significant improvements in infrastructure there. Roads, power lines, and also hydroelectric facilities. So between our SNIP and Eskay mines, we have 3 new hydroelectric facilities that were built in the last 5 years. In fact, they were just sold for $2.5 billion US. These hydroelectric facilities were not there when Eskay and SNIP were operating back in the 90s and 2000s. So those projects historically were powered by diesel and propane, very expensive forms of energy, especially far up in the north. Now we're able to plug into cheap 6 cents Canadian per kilowatt hour electricity. It's 7 kilometers for us to connect that grid into the Eskay project. You know, when we take a step back and think about all this, like these projects historically operated, SNIP and Eskay, during a time period where metal prices were really low and they had very high cost structure. So now we have the opposite. We've got high metal prices and a much lower cost structure. That was why we were interested in going back into this area and picking up these projects. There we go, a little bit of history about Eskay Creek. So legendary mine, it operated from 1994 until 2008. The average grade of production there was 75 grams per ton on a gold equivalent basis. So 2.5 ounces per ton. That's the highest grade gold mine I've ever heard of. And extremely profitable when it was in operation. But again, keep in mind, there were the price of gold while this project operated was between $250 and like $450 an ounce. Obviously a lot lower than where we are today. The consequence of that was that they had to use very high cutoff grades on what they were mining. So the cutoff grades range from 15 to 30 grams a ton. That is why we were interested again in this asset, because given the difference in cost structure and price environment, we figured that we would be able to go back into this asset and find a lot of gold, you know, say at using different, much lower cutoff grades, and be able to put together something that would be economic here. And that's what we've done. So let me talk briefly about the terms of our option deal with Barrick. We entered into the option in December of 2017. There was a requirement that we spend at least $3.5 million over the 3-year option period. So we've done that. Happy to say we've spent almost $20 million there now. When we exercise this option, which we will, we have until December of this year to exercise it. We have to pay Barrick $10 million in cash, and we have to post an environmental bond that was estimated at $7.7 million. Once we exercise the option, Barrick will then have 12 months to exercise a back-end right to come back into the project for 51% by paying us 3 times our cumulative expense and reimbursing us the purchase price of $10 million and 51% of the bond. Now let me just give a little bit more context on this deal. So basically, we have an incentive not to exercise this option until the last minute, because the more we spend, the more expensive the back-end right becomes for Barrick. So we have a decent treasury right now. We've got about 45 million in cash. So we could theoretically spend that money and add that to the 20 million we've already spent. So we'd be closer to 65 million, and then Barrick would have to pay us 3 times that amount plus the refund, the purchase price. So that would be our intention, unless we're able to negotiate some other type of deal with Barrick such that we would exercise the option sooner. With that, I'm going to turn it over to Kelly Earl to speak more about the geology at Eskay Creek. Thanks, Kelly.
Walt. Thanks. Great. So just going to pull up the slide here of our current mineral resource estimate. So this is our current estimate at Eskay Creek. This was released in the spring of last year, and then we updated it when we put the PEA out in November. So what you're looking at here is the global resource, which currently sits at 4 million ounces at 4.4 grams per ton gold equivalent. There's about 300,000 ounces sitting in this underground portion here on the left-hand side that we didn't include in the PEA, but the rest is all open pittable and included in the PEA. So this resource is very shallow, maximum pit depth of only 236 meters, strip ratio of 7.5 to 1. There's a basalt cap sitting on top of part of the resource. But what I really wanted to highlight here is the indicated versus the inferred ounces. So you'll notice on a tonnage weighted basis, we've got about 14 million tons here in the inferred category, 13 million tons in the indicated category, and we need to bring all those inferred ounces into the indicated category in order to push forward with our pre-feasibility study. So we've been very busy infill drilling. We've done about 4,200 meters so far, and we'll continue, but I really wanted to focus on the potential for the grade as we bring the inferred ounces up to the indicated. So you can see right now, the inferred grade is sitting at 3 grams per ton gold equivalent, and the indicated grade is sitting at 5.9 grams per ton gold equivalent. And this is really a function of drill spacing. So in the areas that were historically mined, so where the underground resources are in the 21B and this area over here on the left-hand side of the screen, this is what's been mined before. So it's drilled on really tight spacings, about 10 to 15 meters. Whereas the inferred ounces, as we get out to the 21A and further off to the 22 zone on the right side of the screen, these are areas that were never mined historically because they were below the extremely high cutoff grade. So cutoff grade started at 30 grams per ton, then dropped to 15 grams per ton. And as our global resource is only 4.4 grams per ton right now, these are areas that were much below the cutoff grade. So because they were never mined historically, the drill spacing is more like 50 to 75 meters. And as you're doing a resource, as you move further away from a drill hole, there's a penalty for grade because of uncertainty. So if you've got 75 meters between drill holes, then the grade automatically drops. So we're very confident that as we do our infill drilling, we'll be able to take this inferred grade of 3 grams and bring it closer to 6 grams per ton. So we're sitting at 4 million at 4.4 grams per ton gold equivalent right now, and our internal goal is to hit 5 million ounces at 5 grams per ton, and we're well on the way there with all the infill drilling that we've done so far. So next I have a video that we're going to play, so I'm going to pass it back over to Campbell to start up the video.
Thanks, Kelly. Here we go.
Great, so this is just a quick overview video of Eskay Creek. It'll give you kind of the lay of the land where we are in the Golden Triangle, and then we'll dive into the resource and I'll talk a bit more about the geology and the metallurgy of the deposit itself. So you can see the triangle popping up here are 3 projects, GJ, which Malt mentions we're selling to Newcrest for 7.5 million, and then SNIP and Eskay. We're going to zoom in on SNIP and Eskay here. You can see Highway 37 and the Northwest Transmission Line, which just pops up there. That goes all the way up to Newcrest's Red Chris mine, which they just bought a stake from Imperial Metals in that mine. Then you can see the access road down to Eskay and the 3 hydroelectric facilities that have recently been built. Then we'll zoom right into Eskay Creek that we have road access to, which means we can drill year round. We're going to zoom in here and we'll see what the open pit looks like in a second. And then we've got a bit of drone footage as well. So this is from last summer. This is the 22 zone pits that you can see the ridge over on the left-hand side. That's right where the open pit would be. So that's the ridge where we would take off. So we're not dealing with super steep mountains. There's no glaciers we have to deal with here. It's kind of rolling meadows. It's a drill there that was on the 21 zone pits. And then the resource will pop up here in a second. That's the main pit. That's where the 21 zones are. And then there's a satellite pit, the 22 zone, which is further to the south. So the 2 colors here, there's 2 main styles of mineralization. There's 2 horizons. There's a mudstone horizon and a rhyolite horizon. This is a VMS, volcanogenic massive sulfide deposit. So it means that it formed on the seafloor millions of years ago. We have rhyolite feeder structures, which are represented in the yellow, and they're below. So they would be hot fluids bubbling up beneath the seafloor. When the fluids hit the cold ocean floor, you get the main exhalative event where all the mineralization dumped out, and that's the mudstone horizon, and that's what you can see in red. So the mudstone horizon's on top, the rhyolite horizon's below, and in that mudstone horizon is where you get all the deleterious elements. So you get mercury, arsenic, and antimony. It's no secret that this project has the complete deleterious element suite, but I would point out that it's really not the Eskay of the past. So the grade and the deleterious elements have a direct correlation. So the higher the grade, the more mercury, arsenic, and antimony there is. So when they were mining at 2.5 ounces per ton historically, it meant that the mercury, arsenic, and antimony were much more elevated. Now we're mining at 4.17 is the grade for the life of the mine. So the deleterious elements are much lower in concentration. And I'd also point out on a tonnage weighted basis, 70% of our current resource of that 4 million ounces is in the clean rhyolite horizon. So there's no deleterious elements in the rhyolite horizon. So 70% of our current resource is really in the rhyolites. Only 30% is in that mudstone, and they really only occur in hot spots within that mudstone horizon. So it's definitely not the Eskay Creek of the past. I'll just bring my screen back up here. So I'm going to jump right in now to the PEA highlights. So this is what we put out in November. So we're contemplating shipping a straight concentrate, 9-year mine life, producing just over 300,000 ounces a year. The average open pit grade, as I mentioned, is 4.17 grams per ton gold equivalent, $638 million after-tax NPV at a 5% discount, 51% IRR. Spectacular project economics. We were very pleasantly surprised when the PEA came out in November. I'll flip to the next slide here, and I'll just show you that we did this at a base case. So that's $13.25 gold. You can see how much better the economics get at the higher case. And I actually plugged spot prices into our model this morning. So I plugged in $17.12 gold, $15 silver, and the after-tax NPV at a 5% discount went all the way up to just over $1 billion Canadian, and the IRR jumped to just over 70%. So this is a project that gives amazing leverage to a rising price in gold. But as you can see, our downside is also covered. So because the grade is so high at Eskay, 4.4, and it's open pitable, we're also covered at much lower. This is a project that would work at $1,200 or $1,000 gold. So I wanted to touch quickly on the mine design. It's pretty straightforward, mining, conveyor belts, but what I wanted to point out here are these existing tailage storage facility and the former waste dump. So they're both in what we call non-fish bearing or dead lakes. So the existing tailage storage facility is permitted. All the historic tailings are stored subaqueously, and we'd be using this again for tailings. It's really the waste dump that I wanted to point out. When the mine started an operation, they were doing direct shipping ore only, and the cutoff grade was 30 grams per ton. So that meant anything below 30 grams per ton was considered waste. And eventually, the later years of mine life, the cutoff grade was about 15 grams per ton, so still extremely high. So this lake, which has all the waste rock in it, has material that had that 30 gram per ton cutoff. So any material below that is sitting in this waste dump, and we've done some internal calculations. There's several 100,000 ounces sitting in this waste in this lake as we speak. So that'll be a little added bonus that we're going to investigate further as we gain ownership of the project in total. So I wanted to touch briefly on the exploration potential left on the project. I mentioned that we're very much focused right now on infill drilling. So we put a result out about a week ago. We completed about 4,300 meters so far this year. As I mentioned, because we have road access, we can drill year round. So we'll be drilling again, hopefully in June. And we've really been focused on that infill because we have 14 million tons we need to get from the inferred into the indicated category, because we need all indicated ounces as we push forward towards the pre-feasibility study. But there is an amazing amount of exploration upside left on this deposit. So what you're looking at here in gold is the current resource. That's that 4 million ounces at 4.4 grams per ton. And what you're seeing here in blue is any historic drill results greater than 4 grams per ton over 2 meters. So you can see we have a cluster here between below the 22 zone. So these are all outside of our current resource. We have another cluster of drill results that's parallel to the 21 zone pits, and I'll show you a cross section in a second here. And then finally, the depth potential is not yet known on this deposit. So we're sitting at 4 million ounces at 4.4 grams per ton gold equivalent right now. We see a very clear pathway to 5 million ounces at 5 grams per ton. So we'll just show one quick cross section through the 21 zones. You can see the sequences that I mentioned. There's the rhyolite horizon, which is below here in the gray, the mudstone horizon that is here in the orange, and then there's a basalt cap that sits on everything. So we were drilling in this area to focus on infill, and you can see some historic drill results there, 45 grams over 23 meters, 59 grams over 6.7 meters. And we did some infill right beside in order to increase the certainty in the grade, but also hopefully to be able to extend the ounces because this is very tabular and consistent in nature, this VMS deposit. So sure enough, we tagged into 27 grams over 9.4 meters and 17.49 grams over 7.5 meters. So some spectacular grades. And then you'll notice here the resource pit, the outline of it here. We let one of our holes go beneath it, and we tagged into, oops, sorry, going the wrong way here. We tagged into 314 grams over 2.2 meters. So that's one of our best results to date. It's completely outside of the current resource, and it's in a new lower mudstone horizon. So I mentioned that this deposit represents the sea floor at one time. So our main contact mudstone horizon is up above. The lower mudstone horizon represents where the sea floor would have been, say, 1 million years earlier. So it's very common to find VMS deposits in stacked sequences. So we're very excited about this hit, this 314 grams over 2.2 meters. And we've modeled up a couple of historic hits that were in that area, but for the most part, it's really untested. So this is going to be an exciting new area that we're going to focus on once we finish the infill drilling and open up to more exploration drilling. And with that, I'm going to pass it off to Walt, and he's going to talk a bit more about the comparisons between our deposit and others in the world.
Thanks, Kelly. An old timer once said to me that good grades make for good miners. And what he meant is the higher the concentration of your deposit, obviously the more profitable it would likely be. But the other thing is it gives you margin of safety. And you can see where Eskay stacks up right there. On the first bar graph, is a comparison of open pit deposits in North America and Australia. And the second chart below is the global comparison. So you can see Eskay sits far to the left as one of the highest grade open pit projects in the world. And again, what that means translates to is profitability and margin of safety. And you see the profitability reflected in our very attractive payback periods and IRR on the project. Now looking at valuation, our market cap today is around 160 million Canadian dollars. A typical way mining projects and companies are valued is take the market cap and divide that by the net asset value of the project. In other words, the NPV of the project. So you'll remember the base case that we used was $13.25 gold, which results in an after-tax NPV of 638 million. So if we take our current market cap and divide it by our after-tax NPV at 13.25 gold, you get a 0.2 times price to NAV, which when you compare that to other projects that are advanced stage development, a couple that have just started production, you can see that Skeena is looking relatively cheap by comparison. We would expect that over the next year and a half, as we advance the project through pre-feasibility and feasibility and get it closer to production, you're going to see that price to NAV ratio rise, and hopefully to something similar to the other companies that you see on the far left of this comparison. So we hope that as we advance the project, we'll move closer to that 0.8 times NAV price to NAV, which would in effect mean a quadruple on the stock from today. Obviously, everyone on this listening in on this web broadcast is interested in what the stock performance could be, and so that's how we look at it as what the upside is on this project in the months ahead. Go ahead to the next slide, Kelly. This slide reflects the capital intensity ratio for Eskay Creek. It's a very attractive project when you look at the amount of ounces of production we get relative to the CapEx. So you can see with Eskay Creek, we're expecting a CapEx of around 233 million US. And for that amount of CapEx, you'll see we're projecting 306,000 ounces per year of production. And when you look at the CapEx of some of these other projects on this chart, you'll see that they have a higher CapEx for a lower amount of production. So the point is Eskay has a very attractive capital efficiency ratio. Next slide, please. So one of the very attractive things about Eskay, no surprise, is where it sits on the cost curve. And that's, again, back to that, the grade. So with a grade of 4.17 grams per ton, we end up having a project that's in the first quartile on the cost curve. You can see that our all-in sustainable cost works out to $615 US per ounce of production. So very attractive again. Next slide, please. So just talking a little bit about our plans going forward for Eskay, as Kelly mentioned, we were drilling in February. We drilled about 27 holes, and then we had to shut down due to just a precaution of the coronavirus situation. We plan to be back in there in June, and to complete that phase 1 infill drill program, we've got another 159 holes to go, which equates to about 24,000 meters of drilling. Once we complete the infill drilling, we'll be able to move to pre-feasibility, and our goal is to have that pre-feasibility study done in the first half of next year. Going back to that drilling, Kelly mentioned that our goal is to, with the infill drilling, grow the resource to 5 million ounces with an average grade of 5 grams per ton. And I expect that increase in grade will have a tremendous impact on the project economics, because there's no additional cost associated with it. It's just extra revenue per ton mined. Paul Getty is our VP of Exploration. His bonus is very much tied to achieving that result, 5 grams, 5 million ounces. So we'll look forward to his progress this year on achieving that goal. Also, we're working on metallurgical test work, geotechnical test work, everything we need to do to position this project to move it through pre-feas and feasibility. We've also commenced our environmental baseline studies. All of the permitting processes are underway. The next major, I think, catalyst for the company is going to be the exercise of the option with Barrick, so that we own 100% of Eskay going forward. I'll talk a little bit about SNIP. We optioned SNIP before Eskay. Again, it's a mine with a legendary history. It operated from 1991 until 99, produced 1.1 million ounces at almost an ounce per ton. Again, a kind of grade that you just rarely hear about today. We have optioned this property to Hochschild, partly because 2 years ago, we realized that Eskay was going to be our focus, and at that time, we didn't have the resources really to push both projects. However, the other attractive piece of bringing in Hochschild is Hochschild are experts in narrow grade underground mining, so we felt it would make for a great team to have them involved in this project. So right now, we still own 100% of it. Hochschild has another year and a half to decide if they would like to come in and earn 60%, in which case they would have to pay us, or not pay us, they would have to spend approximately 2.75 times what we spent on the project. That includes an anti-dilution clause to earn the 60%. So far, we've spent just over $20 million on this project, and we would love to have Hochschild as a partner. Starting in late May, June, we'll be drilling here. We're focused on the 200 footwall. That's where we had the best results we've ever had on this project. Back in December, we drilled, well, actually, I'll let Kelly talk a little bit about some of the drilling that we've done at Eskay. So Kelly, I'll turn it over to you.
Thanks, Walt. So we've just got a quick cross section that we'll show here. That'll just give an idea of where we're drilling right now and our focuses. So SNIP is a narrow vein shear hosted deposit. So it's very different than Eskay Creek. Eskay Creek is very consistent, tabular in nature. And SNIP is very narrow veins that pinch and swell. And historically, you can see this one twin zone vein over to the left side of your screen produced 762,000 ounces at 29 grams per ton. And when we were doing some surface drilling in 2016, we tagged into 16.24 grams over 13.5 meters. And we modeled up some of the historical drilling in the area, which was below the cutoff grade at the time. Remember, this mine started with a 12 gram per ton cutoff grade, and then by the time mining ended, it went all the way up to a 24 gram per ton cutoff grade. So anything below that was just considered waste. So we modeled up some of the historical results, and sure enough, we think we've tagged into the other side of a shear zone. So we've got two sides of a shear zone right now. We're calling this the 200 footwall zone because it's 200 meters into the footwall. We did some drilling there last summer, and you can see the twin zone projection here. This is the 200 footwall over here on the right-hand side. And sure enough, we tagged into our best hit to date, 1,131 grams over 1.5 meters. So just spectacular drill results. Unfortunately, this drill hole over here, number 43 that we completed earlier, didn't quite hit the 200 footwall zone. We think it's dipping steeper than we originally thought. So this is our main target when we get back into drilling, and we think that drilling will start up in June or July this summer. So with that, I want to quickly touch on our partnership with the Tahltan and our efforts in the BC Regional Mining Alliance. We think this is something that really sets us apart in the mining industry. Skeena is the founding member of this alliance. It's the first of its kind partnership between the two First Nations in the Golden Triangle, the Nisga'a and the Tahltan, the British Columbia government, and several junior mining companies in that area. But we also have some more mid-tiers and majors that are looking at becoming partners as well. This is about 2 years old now. The Premier of British Columbia gave us $1 million towards this initiative, and the sole focus is to promote mining investment in the Golden Triangle and education on mining. So it's been extremely successful. We've traveled the world with the president of the Tahltan, Chad Day, and we actually hope to announce some pretty exciting news with our Tahltan partners in the near future, so stay tuned for that. So Walt, I'll throw it back to you if you quickly want to go on to capital structure as we wrap it up here.
Sure. So we've just completed a financing about 2 weeks ago. So we brought in 33 million Canadian dollars into the treasury. Combined with 8 million that we already had on hand, put us around 40 million. As Kelly mentioned, we're closing the sale of GJ here shortly in the next few days, and that will bring in another 7.5 million. So when you put that all together, we should be over around 45 million of cash in the bank. So we're in a very strong position for a junior company. With that amount of cash, we can easily fund the activities that we have planned. And when you look at our market capitalization today, around 160, call it 65 million. When you subtract out the cash, our enterprise value is just, like 120 million. So again, I'd argue very attractively a valued company for anybody interested in making an investment into a gold, silver developer. Last thing I'd mention is we do have some warrants expiring in June. They have a strike price of $1. So if the shares are trading over $1, we would expect to take in approximately another $5 million of cash into the treasury. So very strong balance sheet. And I would just lastly say that everybody who's involved with this company, our management team, our board, are extremely excited. We think we have a very special asset in Eskay Creek, and it's going to be exciting to see how things unfold here, especially with the backdrop we have for a rising gold price environment. So Campbell, thanks very much for the opportunity to present to your audience today.
Sure, we have some questions that have been sent in, and we've got quite a few, so I'm just gonna fire them at you. So how confident are you about Eskay being fully permitted for the mine's full lifespan as an open pit mine?
I would say extremely confident. The easiest way to get there is to look at the other mines around us that have been permitted. I use the example of the Red Chris mine, which is an open pit mine. It's about 175 kilometers north of us. Another example would be KSM has received all of their permits. That's open pit underground, much bigger than Eskay Creek. I'd point to Galore, which is a project owned by Teck in Newmont. Again, that's a project with a multi-billion-dollar capex that's likely to go ahead as well. I mean, we're much smaller than these other projects that are around us. We're a brownfield site, so this project was already permitted, granted as an underground mine, but we think we have a very supportive provincial government, and we have a very strong level of support from the local communities in the Tahltan First Nation.
What is spend to date on SNIP, and do you expect Hochschilds to earn their 60% option?
Yeah, I touched on this briefly. We've spent just over $20 million at SNIP, and in my conversations with Hochschild, they've said to me they would like to see 1 million ounces of resource put together there before they would exercise their option. I'd add that we are looking very carefully at the possibility of combining SNIP with Eskay Creek, and we are doing that evaluation right now with our engineering companies. It's looking quite positive, but we want to be sure about that before we come out with any sort of formal announcement in that regard.
Okay. In the PEA, the main mining related to challenge early in the mine life seems to be blending ore types to bring down the deleterious element content of the final concentration. Looks like the mine schedule brings forward high-grade ore, which is exhausted in year 2. Is there currently an emphasis to explore at depth for additional high-grade ore to sustain the blending of high-grade ore?
Wow, there's a lot going on in that question.
Yeah.
So the first thing I'd say is we did not put any sort of blending strategy into the PEA. We basically went after the higher grade material first, and our engineering firm did a trade-off study to determine whether it made sense to blend to try to reduce the penalties, or was it better just to go after the high grade and pay the penalties. And you're right, the first 3 years have higher grade, and they have levels of deleterious elements such that we incur penalties. We think that's probably the right path. As we go through pre-feasibility and feasibility, we'll have a better confidence level on that. There's always the option if we needed to blend down the deleterious elements. We've got more than one pit, so it's manageable. It's something that we could do. We'll just have to see how things play out here as we move it forward.
And as Walt mentioned, the potential of looking at SNIP. SNIP is very clean ore. They were recovering gold doré 50% gravity separation on site when it was in production. Very clean ore. So that's one of the reasons why we're looking at the possibility of blending SNIP ore with Eskay, because it would bring so much clean high-grade ore into Eskay, but a bit too early days to tell, but definitely something we're investigating.
Okay. 51% IRR for the gold mine. Can you comment? Are you happy with that? Could it be higher? Should it be higher? Is that a? It
will be higher with today's gold price. So as I mentioned, I plugged in spot today. What did I plug in? $17, $12, and $15 silver, and the IRR went to over 70%. So
that's an after-tax IRR.
After tax, yes. So as the price of gold rises, the IRR will continue to rise. But I think we were quite happy with 50% after-tax IRR to begin with. Walt, were you?
Yeah, I mean, I think it's almost unheard of in the mining industry to get these kinds of IRRs. So extremely happy. As Kelly mentions, with the higher gold price, it's got awesome leverage to that. But I would remind people, if we can increase the grade, then that's going to have just as strong an impact on the financials, profitability.
Can you walk us through the steps of the additional feasibility work timelines, and assuming your go as planned, the projected timeline to mine construction and production?
Well, I can, right now we've got a good handle on our ability, we think, to get through the pre-feasibility and the feasibility study. So the first half of next year, our goal is to have the pre-feas done, and in the second half of next year, we complete the feasibility study. Beyond that, I don't have the level of confidence, because there's still a number of discussions ongoing with the Tahltan and the province on the permitting side. We'd love to convince the province to show us what they can do in terms of their support for the mining industry by getting Eskay permitted faster than any other project's been permitted. Remember, it's a brownfield site. It's got strong First Nation support. If ever there was a project that deserves to be permitted quickly, it's Eskay. So I don't know where those conversations are going to lead out or result in terms of the timeline yet, but we're cautiously very optimistic, and I'll just leave it at that.
Kelly mentioned in another video the hope to negotiate an agreement with Barrick by June. Can you expand any further on what that negotiated settlement would look like?
Sure. We have ongoing conversations with Barrick, and basically we propose that we would like to go ahead and exercise the option now if Barrick were willing to waive the back end right. And we told Barrick we'd be pleased to provide them with extra consideration, extra payment, if they would waive that back end right. So that's something that we are talking to them about, and hopefully we'll have a positive outcome. The alternative is we'll wait to the last minute to exercise the option, and we've got a strong treasury, and we've got the firepower to spend the money to make sure that the back end option is very expensive.
Assuming Barrick opts to back in Eskay, what capital would you need to keep your 49%? Can you use Barrick's debt rating to borrow this capital?
No, we wouldn't. I don't envision we need to borrow any money, because we've spent 20 million on Eskay. We've got 45 million in the bank. We have some other sources of income that will come in, or capital that will come into the company over the next couple months. So I could see that we could easily spend in total 65 million on Eskay. There's a 10% management fee on top of that. So call it 70 million in total spent on Eskay by December. Barrick would have to pay 3 times that number. So that would be 210 million. Plus we are reimbursed on the purchase price and half of the bond. So that would lead to a $225 million cash payment from Barrick to Skeena. Right now, we're estimating a CapEx of, in Canadian dollars, just over $300 million. So our half of that would be 150 million. With Barrick's payment to us of 225 million, we have more than enough money to fund our portion of the capital to build the mine.
Okay. That's you answered a lot of these questions. Monthly cash burn.
It all depends on how many drill rigs we have out there. A quick rule of thumb is for every drill rig, it's $1 million a month. So we had intended to be drilling in March and April. As mentioned, we shut down just out of precaution with the coronavirus situation. We expect to be back in there in June, and our strategy is just to add more rigs to catch up on where we were delayed. So originally we were drilling with 4 rigs. I could see us easily ramping up to 6 or 8 rigs over the next couple months.
Drilling aside, what is your SG&A cash burn?
Yeah, it runs us about 250,000 a month.
Excellent. Here's a cheeky question. How does Skeena compare to Great Bear?
So I find the valuation, listen, I'm a former shareholder of Great Bear. I've made some money, wonderful things. It's like comparing apples to oranges, right? Comparing a PEA level brownfield site with an exploration stage project is very different. I know there's a lot of hype and excitement about Great Bear, and I believe most of it, but you're just comparing completely different things. We are PEA, brownfields, First Nations, a wonderful resource, 4 million ounces that's on its way to 5. It's just really not comparable. We're headed towards development stage. So while I think they're a great company and it's a great asset, we're much further advanced. It gives much more certainty on an investor's point of view to be investing in something that's PEA towards pre-fees with all the certainty we have behind ours, as opposed to a greenfields exploration site.
Yeah. Excellent. Now I'm going to turn to my colleague Stu McLauber here at Amvest. Stu, are you there?
Yes, I am. Thanks, Kelly and Walt, for the presentation. So as a previous underground operation was, just getting webcam on. There we go. So as a previous underground operation, did Barrick look at this as an open pit development as you guys have, or was that something you guys thought about in-house?
Well, Walt, you want to take that one?
Sure. My understanding is that back in 2000, near the end of the mine life, Barrick did take a look at that. But you have to keep in mind, this mine was shut down in the first quarter of 2008. So basically in the middle of the global financial crisis. So there was that backdrop to Barrick's thinking. The second aspect is just the size of the project. I think in the last year of production, it was between 100 and 200,000 ounces coming out of Eskay. And for the size of Barrick as a company, I just don't think they have an interest in projects of this size. Mark Bristow has been quite public in saying Barrick's interested in tier 1 assets that have a minimum production of 500,000 ounces a year, 5 million ounces, at least a 10-year mine life. And we're not there with Eskay. I mean, maybe at some point in the future we'll get there, but as of right now, we're not. Kelly?
You have to remember cutoff grades as well. So price of gold was the decision to shut the mine down was made in 2005. Price of gold was, around $250 US. So because the cutoff grade was above 15 grams per ton from the miner's standpoint at the time, this deposit was completely mined out, right? Our average grade is 4.4 on a global resource right now. So when you had a 15 gram per ton cutoff, there was no resource left. We've modeled it up at a 15 gram per ton cutoff, and they took out all the high grade ore, and there was really nothing left behind when you had a 15 gram per ton cutoff. So it didn't make sense to try and look at it from an open pit perspective. The cutoff grades were too high. The government was less favorable to open pit mining at the time, but the times have changed substantially. We have numerous open pit mines in the area right now. Price of gold is so much higher. The $2 billion worth of infrastructure, which means we can drop the cutoff grade. It's a very different time for Eskay now than it was when it was in production.
Mm. And is the current, you mentioned the 3 hydro plants nearby, does the current PA contemplate the power costs from them, or that's something that could be added in the future and, improve economics?
The PEA contemplates connecting into the hydro plants and into the grid at 6 cents per kilowatt hour. I would also mention that Tahltan, the First Nations, are part owners of the hydroelectric facilities that are right near site as well. So they're incentivized.
That's handy.
Yes.
Are there any expected operational difficulties while working above the old development openings and stopes?
My understanding is the answer would be no, because the stopes were backfilled with a combination of river rock and cement. So in fact, there's better ground stability in those areas that were backfilled than there is in the general geology that would make for the pits.
Mm. Gotcha. And then in the current resource, what percentage or proportion of the drilling you guys have done makes up the resource compared to the historical database you inherited?
So the majority of the resource is based on the historical drilling.
Yeah.
And
you just reanalyzed all the historicals.
Exactly.
Your own system.
So the first, I'd say 9 months after Paul joined the team was just, first of all, hunting for the data. The data room that we received was really lacking in information. So we had to send a team to go find the old drill results. And then we really had to work from the ground up on rebuilding the entire geological model. We have a great in-house resource geologist, Kathy Dilworth, who started the model from scratch. But yes, most of it was based on the historic drilling that happened at Eskay, and then we're just adding to it with the current drilling that we're doing.
Great. Thanks for the presentation. That's all questions I have at my end.
Thanks, Stu.
Okay. Last but not least, Gabriel Alonso Mendoza, also from Amvest. Gabe, are you there?
Yep. Hey, Walt. Hi, Kelly. Thanks for the presentation. Good stuff. Just wanted to ask about sort of optimization of the PEA or the mining plan. Is there anything that you can see sort of low-hanging fruit, and have you done sort of trade-off studies about a joint open pit underground operation on Eskay?
No, we haven't gotten to looking at whether we could add an underground component to it. I think the near-term low-hanging fruit, I guess I would identify 3 opportunities. The first would just be completing the infill drilling, because we hope that will raise the grade and the size of the project. The second opportunity is combining in SNIP, because as Kelly mentioned, we get clean ore from SNIP that we can mix with the first couple of years from Eskay to reduce the penalties and probably improve the grade. The grade over at SNIP is looking like 9 to 10 grams. The third opportunity is in Albino Lake, like the waste rock pile there. We don't have a handle on how much gold might be sitting in that waste rock pile, so it's something we need to investigate. And then I said 3, but actually I'd add a 4th opportunity. It's just the exploration around Eskay. Like there are lots of historic holes that have intercepts that we think are pretty good, but back in the 90s and 2000s, they weren't. They didn't meet those cutoff grades that Kelly mentioned. That 15 to 30 gram cutoff was a pretty high bar for the guys doing exploration back in the days when Eskay was operating. So, on a combined basis, I'm pretty sure something's going to work that it will allow us to grow the size of this project.
So I mentioned that there's about 300,000 ounces of underground resource right now. So that's one of the reasons it's not quite large enough to consider an underground portion to the mine yet. But that new lower mudstone horizon where we tagged into that spectacular 1,100 gram per ton hit, that's an area that could potentially have underground potential as well. So we need to do a lot more exploration, specifically in the underground areas, to determine just how much this resource could expand. But the potential looks pretty amazing right now.
Sure. Do you have access to like the old development openings and stopes to drill down there?
No, so as Walt mentioned, it was all paste backfilled. So
Okay.
It's completely solid right now, but we will in the future be able to drill right through those from surface. It's a very shallow deposit. I think some of the deepest drill holes are only about 250 meters right now. So because it's so near surface, it actually outcrops that surface in the 22 zone. We're able to do all our drilling from surface.
Got it. And well, earlier this month, you mentioned on the Corellin report that there'd be some surprises that we should expect. Is there anything that you can hint to or give us some color on?
Well, they wouldn't be surprises if I told you what they are.
Fair enough. Fair enough. Yeah, guys, that's all I have. Thank you.
All right. We've reached the top of our hour. If you have any more questions, just send them in and we'll get them answered due course. Thank everyone for tuning in today. The link will also work for the replay. And so I encourage you to check that out again, or I'll be following up with all of you to get some feedback, and that's always much appreciated. And I'll turn it over to Kelly and Walter for a closing remark.
Well, Campbell, I just say thanks to you and your colleagues for organizing this. It's amazing. Some of the silver lining of this coronavirus situation is learning to take advantage of these other technological mediums to introduce Skeena to a wider investor audience. So thanks for your help on that front.
And also to everyone listening, if you have any questions, please reach out to Amvest, or the info@skeenaresources.com email address is on the screen right now. Please shoot us any questions you might have.
All right. Thank you, everyone. Good day.
Thanks, Paul.
Bye.